how to amplify your income in a zero interest rate world. 3 ways we're going to get to that goal today. 1, we're going to talk about the secret account to amplify your dividends instantly. Number 2, we're going to create predictable on-demand cash flow. And 3, my spin, how to pad your account by this supercharged income and growth strategy. How much money do you guess that is? Somebody guess.
100,000.
100,000. No, it's $1 million. Doesn't look like a lot. That's what it was used to be, where the typical retirement could be. If you had $1 million, you'd be set. Well, it's not that anymore. What they're saying is it needs to be about 3 million. This is according to Fortune magazine. They asked a couple of professionals, but 3 million. So we have to amplify that. Now, as we know, middle class is right here. We kind of got here, we'll trace back, but with the zero interest rates has really caused the middle class to become squeezed in the middle here. The old way was save a penny, or a penny earned is a penny saved. It's not that type of environment anymore. Money burns because of inflation. And it started with this guy, Alan Greenspan. 30 years ago, you put your money in a bank and everyone wants you to put the money with them. House, Wall Street, banks, everyone wants you to put your money with them. Well, when you fall into that trap and you don't get paid on it, well, that's what happens with the middle class. You're not making enough. So Alan Greenspan kicked it off with the issue, caused the dot-com bubble. We're all part of that. Then came the credit crisis, caused by him as well. And then this guy, Ben Bernanke, caused what we're in right now, this 10-year bull run of these inflated prices. So here is a 10-year chart of the SPY. We all know what it looks like, but over 300% in that time frame. And when you're an individual on fixed income looking to generate income, you want that asset to be stable to create cash flow. Well, the problem is that if it's increased in value, that dividend has gone away. We've kind of backstepping and tracing into it, but I'm backing into this. What it's caused is Wall Street to inflate the overall marketplace, causing the amount of money that an individual has to be able to purchase stock. Look at Amazon, look at Google. These stocks before had to do stock splits to appeal to the ordinary investors, you and I. They don't have to do that anymore because they want you to go passive. Passive is, we'll take the money from you and we'll invest it. So they don't have to do the stock splits anymore. The companies don't have to do it. So when you have a certain amount of cash, you can't diversify that, or you can't buy enough of it to really create that dividend or that fixed income that you need. So this is where we're at. We're caused by this situation in the overall marketplace, by inflated prices. It's us versus them. The first way is leverage. Now, a lot of you are older and are grown up on the aspect of put your money in the bank, get a return. That doesn't happen anymore. Everything about, especially on this chart here, is about leverage. So it's us versus them, and we have to play in their rules. So we're all familiar with the normal no margin account. It's a cash account, meaning there's no leverage and everything's cash secured. It's the most safe approach. There's no leverage in it at all. The easiest account with leverage is a standard margin, which most of you have and you probably are not aware of, but you get 2 to 1 on stocks. So you're able to put stock buying power and capture a 2 to 1. Well, that's good if you use it, but it still is not enough if you need to diversify it. Portfolio margin. This is where things get really interesting and we can level the playing field. The reason why is because now you're getting leverage on stocks that you weren't getting in a normal margin account. Now, leverage for some people is very dirty, but a lot of people use leverage in everyday life. Houses, cars, everything's leverage. The financial markets are different. People get weary of it. And that's just because of lack of knowledge or just fear of losing money. So you get about 6 to 1 on options and 12 to 1 on stocks. A lot of people don't know this. Even brokerages aren't familiar. You contact the trade desk and they are not even familiar with portfolio margin. That's why I call it a secret account. The individuals that know are able to do it. So for instance, if you had 250,000, you put that with a mutual fund, that's 1 for 1. With portfolio margin, you get much more benefit and increase that leverage. So the benefit is that we're diversifying our capital with portfolio margin. Why? Because we have more money to leverage, to be able to create income and also control assets. There's benefits using options, and we won't go too far into that, but there's benefits of using options with this portfolio margin, but you just have a bigger playing field to be able to use and level the playing field. So, example, we take a $100,000 account and a normal standard margin. Buying power on that for stock is $200,000. Option buying power, $100,000. Portfolio margin, $1.2 million on your $100,000. You can control that. Now that's the ceiling. I'm not standing here saying let's run it up to 1.2, but that's the ceiling that you have to be able to work yourself out of position sometimes. But that's the max that you get on that. What we're saying is instead of getting to 1 to 2, get 3 to 1, get a little bit more of a cushion, but there are opportunities there to work out of market drawdowns and use and keep more cash instead of using all your cash and get knocked out of positions. And option buying power is half of that, about $6 million. So here's my little diversified portfolio. I called Jim Cramer, called him on the phone. He said, I'm diversified. We have AT&T, we have Kraft, we have Newmont Mining, we have Philip Morris, and we have Exxon. Pretty diversified, right? 5 positions, totaling 20,000 each, 100 grand. The initial margin on here, and these are some numbers that are going to be a little confusing at first because they're thrown at you, but initial portfolio margin 17 grand compared to Reg T, which is normal standard margin, is 25 grand. The relief here is what we're talking about at 15 grand versus 25 grand. That's 10 extra grand that we could do a lot more with and create opportunities. Also, just keeping cash available when markets do draw down. So here, I'm going to take one of those stocks, AT&T. Right now, it has a 5% yield, 38.58 for this. So we use portfolio margin. We had standard margin, 10,000 shares, $38.50, which is right around Friday when I took this. 385,000, 50%, $192,500. That's what you would need to control that. Portfolio margin, we only need 15% of that to control it. 57,000 to control a $385,000 position. Yielding 5%. What's the return on capital? 385,000, and the yield equals $20,000 in amplified income. Creates a 35% return on that capital used. So within that time frame of using extra capital, using margin, we've been able to increase that overall yield and have an asset that, if it did appreciate, still we were able to participate in a meaningful way of buying enough shares to be able to participate on that as well. Portfolio margin requirements. So typically, they're going to range. It ranges from anywhere from 100,000 to 2.25. And this is from 20 years ago where you needed a $5 million account to be able to do the same. So they brought it down for ordinary investors because what Wall Street likes is to keep you guys away from what you're able to do because they want your money. That's how they get paid. To get this, you got to get full options approval. So the financial industry makes it a little difficult to be able to do useful things for ordinary investors, but getting the full options trading approval isn't hard. That means a level 4. You have to get an 80% or better on the option test and also on the portfolio margin requirement test. It's not difficult. It's very easy, but they make you work for it. And usually at the end of the day, depending on the account, you need about 100 grand in net lick. Net lick is net liquidation value. So obviously you don't want to run up the margin, but you're able to do more with what you have than you were before with this account. And it's always good to have that extra there to be able to control that. Now, there is interest related to the margin, but if there's zero interest, they're giving you out a little bit more. Banks make money on what? Taking your money and giving it back to you at a higher rate. So here's how to become the bank, use that asset, and be able to make more from it. Now, the next thing, we just amplified the income. We amplified our holdings. Can we get paid a lot quicker than once a quarter? I got to pay my rent every month. You got to pay your mortgage every month. You got to pay bills every month. How do we control that same asset, same basket of assets, my diversified portfolio, but be able to create a consistent cash flow? The only thing better than an asset that produces one stream of income is that it produces two streams of income. So BMH, do you know what that means? Buy, manage, hold. Wall Street's about buy and hold because they need to keep your money at work. The ordinary investor, the little guy, needs to buy, manage, and hold because we need to get money out of it. We can't wait 10 years to get our money, our investment back. We need to be able to manage that, get our money back, and be able to still maintain that asset. So here's a basket of 5 stocks. Now I picked different ones just to change it up a little bit. This is CVX, MMM, HSBC, Walmart, IBM. This is a 10-year bull run here, comparing this, which is selling covered calls, versus just owning the stock here. So the blue kind of purplish line here is the basket with the covered call. The red is the stock. Now they look pretty hand in hand, right? Because they are. I mean, at times it created more alpha and at times it dipped down a little bit more. But the difference in this, owning stock, is that you got paid quarterly on the dividend. On our approach, we got paid more often. So what we did here is we did a covered call, and this, we did 45 days to expiration. The other two numbers are, when you're doing this, you're never going to get like the exact 45 days. So you have to have a parameter. These are a parameter here that captures in between. So the idea is 45. The strike that we're looking at is a 15 delta. So for those that aren't familiar, a delta, an out of money strike, those are out of money calls. 15 delta is the delta of that option. So it's an out of money call, it's a 15 delta. The range, 2007 to 2020. So it's 13 years, not 10. Up top there, we got a bunch of numbers here, but I highlighted a few of them. Up top, 8.36%. The strategy win rate, 85%. It's kind of misleading. It's a bull market. But you're told that you can't cap your upside, right? If you sell a call, I'm not going to be able to get my upside. That's wrong. Numbers don't lie. The other part of this is that there's 556 trades. You had 5 stocks. You have to, in a 13-year period, you got to be active. You got to manage. If you want the cash, you got to be a little bit more active. And it's not that difficult, but it is. More engagement creates more cash flow. So this chart here is just isolating stock versus selling a call. So if we just sold the call of these 5 stocks here, the same way, this is what it looked like. This is taking that, capturing that cash flow, or selling the call, capturing that premium, and showing it against here. So even if you just sold the calls, you're right at that $100,000. And sure, you missed up on the upside, but that's different. You're not selling, you're not just owning stock, you're also owning stock and calls, which you get the benefit. So here's this isolating that. The annual rate on just selling that was 0.08%. That's where that 85% rate comes from. But I want to emphasize the fact of you're told that you're limiting your upside when you sell a call, which is incorrect. 731 trades, and the worst monthly return was -2%. It's not bad. I mean, if you just sold calls in an up market where you're told that you can't do it, it's going to put you in bankruptcy, blow your account up. Numbers don't lie. These are numbers. 13 years. You do a long-term time frame to get the right numbers. You don't do short-term time frames to try to back data into it. You make longer-term data fit what you are looking for. So as I said, covered calls, creating that cash flow on demand. It's pretty easy. We talked about one, doing the margin. using the leverage. Not for everyone. But if you want to get to that 3 million, that's where you have to get to. But the covered calls, we increased it. We created more extra cash flow. Options 1 level approval, pretty easy. More work, sure. But you get paid. You're not waiting quarterly to get paid. You want to get paid as quickly as you possibly can. Selling calls on your asset is the best way. The little nuances on here are you got to be aware of dividend dates, because with the options, you got to be understanding of that. Once you understand it, then you do it. But to be transparent, ex-dividend dates are important. And again, you theoretically limit your upside. Well, the numbers don't lie. The numbers show that you don't theoretically limit your upside. So my favorite one here, supercharged growth and income. So we created more cash flow. We have got the leverage. How do we boost our accounts? I call this the stock replacement covered call. Not that fancy, but when you're in a marketplace where you feel things are overvalued, let's say you have a stock and it's gone 10 years and you're like, I still think the upside is there, but I want to take my profit and I still want to participate in the upside. This is what a stock replacement is, or just a type of approach to use options instead of using and tying up all the value in your account. Again, if you're not going to take the margin, you're not going to do the cash flow, well, if you have a small account, how do you supercharge it? Stock replacement, doing the same thing. So we're going to do a long 80 delta call, which just means it's in the money, has an 80 delta. So it's almost 1-for-1 for stock. It's like owning stock, but it's not. 162 days to expiration. So that's about 6 months. Now, there's no exact science. 162 days is just what I came up with. It could be 159, 170. Short a 30 delta call. So we're going long, and meaning short is that we're selling it. So we're almost creating like a frame here that we want prices to stay within. But again, it's like our stock. We want the stock to increase higher, and we also want to use that covered call to take that premium and collect it against what we already own, create that cash flow. What we're doing here, so I'm creating some parameters, which is necessary when you're investing. I have a 515 presentation. Well, I'll talk more about the aspect of managing, but this is important of knowing how to get out of trades and how to do it profitably. So we closed it new trade when 45-day call expired. So what that meant is when this short 30 delta call expired, we closed that long and opened up a new one. Now I use Microsoft, but that blue line is owning Microsoft stock. And the reason why I did Microsoft is because technology stocks or NASDAQ stocks are not the typical recipe for a portfolio if you're trying to use it on fixed income or try to create dividends. So a lot of opportunity has been missed. Even Warren Buffett has had to go into technology because the game has changed. His approach worked 30 years ago, it doesn't work now, and you have to do what's working now. So this was owning stock compared to the strategy that we just put together, the stock replacement covered call. In this time frame, which is 2018 to 2020, it yielded about a 400% return compared to 100% return. Let's look at the numbers. We risked on our stock replacement strategy, our savvy approach, we risked $1,430 compared to owning the stock, which would have been at first $90 and then ending at $183. The return, 402%. Overall return on our 1,430, 5,746%. One of the key things that we always want to look at times is the win rate. Now, for some people, the win rate matters because being right more often keeps you more engaged and more excited. This win rate here is at 88%. That's pretty good. Benefit, overall market going higher. One key to understand is that the market always has a bias of drifting higher because that's how money works. Money always has to be put into the market. It can't be taken out because they don't get paid. So doing this, instead of owning stock, we're able to supercharge and generate those bigger returns. Again, 400% compared to the 100%. It's pretty good. Being able to have that and add it into a portfolio where you still have the opportunity to create dividends. If you don't want to use leverage and you don't want to do cash flow, at least you can use some of the cash to participate and boost that income, because that's what you need to do. As value comes out of that asset, you have to continue to keep that asset at that value, if not higher. So one of the things I always do is you always want to create a better cake. How can we make this more beneficial, more profitable? So we start to add different things in here. So we have the same thing up here, closed when the new trade, the 45-day call option expired. But what about if we said this, or if the gains were 50% and then we opened a new trade? So what that means is that when we met a 50% profit on that, we open up the new trade, we close it and open up a new one. How would that look? What we're doing here is managing our position. So if we look here, it's about 400%, but this did actually yield better returns. And the other thing too is you always want to look, a lot of us we're going to show charts of history, obviously, because it's the best looking case scenario sometimes. It's always good to understand where things dip down, because no strategy is going to work 100% of the time, and there are going to be drawdowns. Nothing's going to be able to save you from a market sell-off. The benefit, the only thing that you can do is weather the storm in a market sell-off. So on this one, as I said, on the stock, is that we got a 460% return, and we actually increased our win rate to 94%, and that was what we're doing. So to scoot back, just adding that 50% management yielded the same return, but if we actually had the 50% gain and then we closed it after 30 trading days. So we're managing positions and we're creating a framework for success. And what that means is 50% or 30 days, 30 trading days. So 30 trading days, so if you don't meet 50%, after 30 trading days, we close it, open up a new one. That yielded that 460% return, and the win rate went up to 95%. Now, I didn't look at all the NASDAQ stocks. I picked one and I worked with it. But what we're trying to show here is that owning stock versus using leverage and using options, we were able to participate, use a little bit of money still to generate big returns and create high win rates, and be able to weather storms where this over time looks very smooth and very left to right going higher, but at times it's not that way. And being active with your positions as this is, you're able to sidestep stuff or work yourself out of those positions, being more engaged. More engagement creates more opportunity and higher returns.